Hi, it's Lori Richardson with Cornerstone Home Lending on Tuesday, September 6th. Happy day after Labor Day. Hope y'all had a great weekend. Wanted to just give you a quick look at the markets. The two most important reports that we saw last week from an economic standpoint were both Friday's employment report and the ISM, the National Manufacturing Index. Both of those numbers fell short of expectations, and despite those results, we saw mortgage rates end the week fairly close to where they started, so very little change in mortgage rates last week. Today we're going to take a closer look at the employment report itself, the ISM report, and probably more importantly regarding those two reports is what do we anticipate the Fed doing as a result of those reports. We'll take a quick look at housing data and then what's coming up this week. So jumping right in, Friday's employment report was mildly disappointing. Against a consensus forecast of 175,000 jobs, the economy actually added only 151,000 jobs in the month of August. Despite that slower pace in August, the economy has added an average of 232,000 jobs over the last 3 months, which is a pretty strong number overall. The unemployment rate remained at 4.9%, although we did see average hourly earnings, which is an indicator of wage growth, fall short of expectations. Taking a look at the ISM Manufacturing Index, which is another important indicator of economic activity, also missed the mark to the downside. The index actually fell to 49.4, which was pretty well below the consensus forecast and the lowest number that we've seen since January. Remember that a number lower than 50 indicates a reduction in this area. Overall, in plain English, the report suggests that manufacturers continue to face headwinds from a stronger dollar, economic weakness overseas, and reduced spending on large equipment from U.S. businesses. So just kind of in a nutshell. Here's the deal though, the story behind those numbers is because the ISM index fell and Friday's employment came in weaker than expected, it is likely that the Fed will be on hold and will not raise rates at the September 24th Fed meeting. It was interesting too this morning, the futures market has priced in, I should say it this way, investors expect about a 25% chance of a rate hike in September. I would give it less than that if I were rating it. The next meeting isn't until November, and here's the interesting thing. It seems to us that the Fed prefers to move or actually change rates when there is a press conference scheduled after the meeting, immediately following the meeting. There is no press conference scheduled in November. So a lot of the analysts are saying if they don't move in September, we probably won't see them move in November, and that the next chance for a rate hike might actually be December. And turning to housing data, we saw the Case-Shiller House Price Index come out last week. That is a report that tracks changes in the value of residential real estate over a 20-city index nationwide. This month's report showed a strong but good pace. Nationally, we saw home prices rise 5.1% year over year. Keep in mind that Denver reported a 9.2% pace of growth year over year and keeping its top spot along with Seattle and Portland. Pending home sales. We had a great showing in July, coming in at more than double the expectation. The increase of 1.3% in July was the second highest reading over the last 12 months. Keep in mind that this is a good forward indicator because it measures signed contracts not closing, so it really on existing homes, so it really kind of gives us an indicator of what's coming. With the low rates that we've been seeing, probably we would have seen pending home sales be higher than that had we had more inventory. So something that all of us are working on, increasing inventory. This week we will see the ISM National Services Index be released versus the manufacturing last week. We'll see services this week. Wednesday will bring the JOLTS report. And then Thursday there's an ECB or a European Central Bank meeting. We're looking at this could be a possible market mover because the ECB announcement, generally speaking, has an impact, or oftentimes has an impact on U.S. mortgage rates in general. So taking a quick look at rates, we're still in great shape. Rates on conventional conforming still in the mid threes, 15-year fixed below 3, FHA still in the very, very low threes, and jumbo 30-year fixed rate loans still hovering in the high threes. So overall rates are great. If there's anything we can do for you, any questions we can answer for you, please don't hesitate to call 720-200-6868. Hope your day's great.